As Monica said, we're going to be talking about future-proofing the banking union. Banking union has been around already for 5 years. It's been worked on even longer than that. There's been a lot of successes in terms of the single supervisory mechanism, the single resolution board. So we want to talk today and hear industry and public sector viewpoints in terms of what has been achieved so far. But it's also not finished yet. There's the Single Resolution Fund, which is yet to be built up. And there's, of course, the third pillar, EDIS, the European Deposit Insurance Scheme, which is still looking for a political traction to be achieved and completed. So with that in mind, we wanted to start in the first round and ask Marie, from a commission perspective, what do you see so far as the greatest successes of European Banking Union, and what are your sort of immediate priorities in terms of what needs to be done next?
Thank you. Thank you for the invitation. I will try to cover everything and be as brief as possible. You may know that the European Commission has released last week on the 12th of June a communication on taking stock of the deepening of the EMU. It had, of course, covered different topics, but one of them was the banking union. Reflecting on the progress so far, what is currently going on, and what are indeed the next priorities, through the three pillars. So the first pillar of supervision, the second pillar of resolution, and the third and still missing pillar of deposit guarantee scheme, EDIS. So I'll go one by one and try to give you a bit where we are and what we see coming as possible next step. Let me first start by saying that, of course, there is a single rule book first, which is then offering harmonized prudential regulation for the single market and supporting a single banking market in the EU as a whole. And of course, it is something which is evolving because we integrate there the international standard from Basel or FSB and adapt to the changing banking union. So it's not necessarily for, there will be imminent step for Basel IV, but we know, for example, so that between now and a steady state banking union, we could expect some changes in the single rule book regarding national discretion and options. I'm sure some of the speakers today will allude to that, so I'm flagging this already. Regarding the first pillar, supervision, as you know, SSM was created and launched with a commission proposal in 2012. It has been then set up and is now fully operational. And the assessment there, I think, is quite successful. Of course, they could rely on an existing structure of supervision authority, rely on a single rule book, but we have now an increasingly harmonized and convergence of supervisory practices. And ECB, together with the National Competent Authority, are entering harmonized supervisory practices in the banking union. There again, as I said, there has been already a review of the performance of the SSM. The assessment is quite positive. They're flagging some areas for improvement. There will be another review in the second half of 2019. I think one of the big items on the agenda will be, of course, AML. You know that the Commission has made a proposal on that last year, and that we expected also to make a post-mortem on the lessons learned there. It's maybe not the core of this panel, but it will be on the radar for, let's say, supervisory practices in the landscape, not only banking union, but probably the whole EU. Then coming to the second pillar, resolution, with the establishment of the SRB and the SRF, starting in 15, fully operational in 2016. I think there, of course, the SRB is much younger than the SSM, and the setup challenges were probably also a bit more challenging than in the case of the SSM. But we published in April also our first review report. I think we can say that it's been also a successful start. They have managed to address all the setup challenges. They had their first cases with some resolution decision, also some decision not leading to a resolution decision, but they've had the first cases. We've had some lessons learned as well. And in that report that we published in April, we are flagging the most main insight in terms of functioning so far. And we are somehow highlighting the main items we will want to probably reflect upon and develop further in the next review. We don't have a timeline there. It will be with the new commission, but we will, let's say, the next 2 or 3 years, have another review of the BRD. So we expect a BRD 3 at some point. We just finished one with the banking package, so you have to give us a bit of time. And we know for sure that the items on the agenda will be, among others, improving early intervention, working on precautionary recapitalization. And a big item which is very prominent in the debate recently is bank insolvency. It's coming up as well in the high-level working group on EDIS. I'm going to come back to it in a minute. But before I go to the third pillar, I want to stress 2 very important priorities we have at the moment. It's the backstop for the SRF and the liquidity and resolution. The backstop, there is a political agreement, will be given, provided by the ESM. There was a political agreement in last December. We were supposed to finish the work now in June in the Eurogroup. We're not quite there yet. There is a principal agreement on the treaty changes, but more work is needed on the so-called term sheet and guidelines to really finalize all the details on the backstop, and we will probably work until the end of the year on that. For us, the Commission, what is very key there is that we manage something which is credible and swift in terms of decision process and in terms of certainty and reliability of the backstop, so that the SRB can rely on it in its resolution decision. We also insist that this is done in full respect of the competences and prerogative of the institutional bodies, ECB, Commission, SRB, and in particular that we preserve the EU legal framework and the capacity of the co-legislator to continue make the regulatory framework evolve. On liquidity and resolution, there the work is more recent, it's still ongoing. We will indeed also continue working in the next 6 months, but we are underlining that the liquidity and resolution is something which is still missing in our current resolution toolbox. We want liquidity to be there, again, in a swift process and sufficient amount. We think that we need to go beyond what we call the status quo. So we need to find new means going beyond the mere refinement of current practices. So that would be the third pillar. Am I doing on time?
You're doing fine.
Okay. Third pillar, of course, it is the missing pillar. It's something which is very dear to, I think, the Commission's heart, but in general, the European institution, ECB, SRB, ESM. We insist on the importance of EDIS for financial stability reason, confidence of the depositor, to ensure the same protection to all depositors wherever they are. As you know, there has been an original proposal in 2015, a communication in 2017, but the debate has stalled and it's very difficult to gain political traction on that file. The whole EDIS debate has been also engulfed in the dichotomy risk reduction, risk sharing. We find this dichotomy, which is quite divisive in the Council and among Member States, quite counterproductive, actually. We'd like to insist on the importance for EDIS to support resilience and robustness in the banking union, and also to complete a consistent architecture in the EMU. As I mentioned already, over the last 6 months, we've had the high-level working group working on EDIS and working more generally on what would be the design of a banking union in a steady state. There has been a report by the chair to the Eurogroup. There are 4 main work streams that are emerging. One is, of course, EDIS, the design of EDIS, the different phases, and we insist on the liquidity phases, but also the ultimate phase, which entails mutualization within the banking union. The second work stream, which is resolution and further improvement in the resolution. I've mentioned already some of the avenues envisaged. The third one is linking resolution, but also the single rule book, and is about market fragmentation and home host issue. The last one is about regulatory treatment of sovereign exposure, RTSE, and safe asset. Now, as you know, from the conclusion of the Eurogroup, we've been given another 6 months, and we are expected to report in December, hopefully with a roadmap which would then allow the launch of the negotiation, the political negotiation on EDIS.
Thank you. Thank you for your very good overview of all 3 pillars.
Thank you.
Doug, given that you've published quite a bit on banking union also before it was created, I was wondering from your perspective, do you feel that it has made the European banking sector stronger? And also, to what extent do you feel that it has fostered a single market? Also given the discrepancies that were mentioned earlier that still exist.
Thank you, Martin. I think you're asking the right questions, because when I think about the success of the banking union, I divide it into 2 broad categories. There's structure and process. Is it set up to be able to do what we want it to? And then what has been the impact to this point?
Yeah.
And on structure and process, we have to remember, nobody's ever done this before. This really is unprecedented and very complex. So I give Europe a lot of credit for the fact that compared to the starting point, I think banking union is much superior to where they started. At the same time, from a structure and process point of view, there's a big gap between where it should be and where it is. So you can be an optimist or a pessimist depending which aspect of that you want to point to. But I'm an optimist by nature, and I do think that Europe deserves a lot of credit for the progress it has made on structure. But then I think it's also fair to ask the question, what's the impact been to date? What was it intended to do, and what has it accomplished? And there, I do think it's important to remember that while there have been very sound theoretical reasons for banking union the whole time, it only really happened because of the euro crisis. And there was an understandable concern, even panic, about the interrelationship of the financial system and the sovereign governments and the sovereign debt crisis. So I'd say there are 4 things it was trying to do. There's probably others, but first was to ensure financial stability within the banking union. And I think it's done a really good job of improving financial stability. You never know if you have enough, but there's a lot more financial stability, I think, in the banking union than there certainly was at the start. Some of that's due to other factors, but a lot of it is due to success of the banking union. The second thing they were trying to accomplish was to eliminate this doom loop between governments having problems, which then create problems for their banks, which create problems for their governments, and you spiral downward. And there I can give at best partial credit, because there have been steps taken to improve it on resolution, which do help, so that there are fewer problems if a bank does go down. But one of the biggest aspects of that doom loop is that the banks own so much in the way of government debt of their national governments. And that has probably gone in the other direction, if anything. I haven't seen recent numbers. But with all of the pressure to have more very safe assets, which is a worldwide trend with Basel III and the completion of Basel III, that you've pushed towards more sovereigns, and almost all of those more sovereigns that are being held by banks are of their principal national government. So, said some partial success there, but maybe not that much. And then you look at the intended effect, which may have been a little more secondary since there was more of a focus on the crisis, but there was a hope that you really would advance the single market, at least within the borders of the banking union, within banking. And there's been very little progress on that. If you look around today, it's not clear that there's much greater cross-border activity within the banking union itself than there was beforehand. In fact, with some of the barriers that have been put up in general around the world, including within the banking union, there might even be less cross-border activity within the banking union than there had been. And then I'd say the fourth thing, perhaps implicit, was the desire that you have a European banking system, and certainly within the banking union, that kind of worked on a long-term stable basis, meaning that you had banks that provided useful services and could make money doing it. And if you look around, nobody thinks that the European banking system taken as a whole is in good shape in that sense. We know a number of the reasons, and we know a number of the things we should collectively do to fix it. They're just not happening. Partly that's the sheer complexity, and partly it's that many of the things that have to happen are difficult politically, or in some cases, they're difficult for the banks themselves. They would mean painful adjustments that the banks may not be comfortable with either. So when you look at structure and process, I tend to be reasonably optimistic, and there are the efforts Maria is talking about to improve that still further. When you look at the overall impact, again, I'm an optimist. I hope that over time the improved structure will lead to improved impacts. But I can't say, outside of the big picture financial stability issues, which are very important, I can't say the rest of it in getting to a system that's long-term stable has made much progress.
Thank you, Doug. Santiago, if we look at the first pillar at the single supervisory mechanism, it's been credited with bringing more transparency across the European banking sector. It's been credited with a more harmonized approach coming, out of the ECB and the SSM. As a bank based in Spain, headquartered in Spain, which used to be supervised there locally, but now, out of Frankfurt, what are some of your experiences as a practitioner with the SSM, and to what extent do you feel that this supervisory mandate is working for you as a European bank?
Well, thank you. Well, I have to say, the experience so far, I think, has been good. I think there is good coordination between the ECB and the national competent authorities. There was a lot of work on best practices, and I think here, something similar to what happened in monetary union took place also in the supervisory field. So part of the process was to confront practices in different countries, to find best practices, to improve methodology, and I think overall our experience is quite good. Of course, there are areas for further improvement, and one of them, for instance, is streamlining reporting requirements, where we think there are very different exercises that maybe overlap and are sometimes overburdening institutions. Probably supervisory policies need to be adapted to all the different banking business models. Yeah. And here in particular, for instance, in our case, we are a bit special in the sense that we are retail, but with a lot of presence in emerging markets, and this is a model that little by little is better understood by the European authorities, but of course this is a learning process. And maybe more predictability in some of the processes. For instance, as regards national discretions, I think we would probably aim at a more kind of predictable and harmonized framework. But the results in general have been good. I think, of course, there are challenges. There are many challenges remaining. One of them is the low interest rate environment and everything surrounding this kind of new normal, if you want. Yeah. Fragmentation, which has been overcome to a large extent since the dramatic times of 2012, when we were, I mean, the euro breakup was a possibility, and I think we are now far from that, and banking union is partly the reason for this success, together with Draghi's whatever it takes, and so we reverse this dangerous trend towards increasing fragmentation, but there are still elements of fragmentation remaining. And well, we are still struggling with if you want, the aftershocks of the crisis in a number of countries and in a number of banks. And we are also facing new challenges coming from a more complex ecosystem with new competitors, with all this digital disruption, new entrants. So all this is of course, challenging, but at the same time, we have to look at what we have achieved, no? And it's the increase in capital levels, the increase in loss absorbing capacity, the improvement in resolvability, with some side effect, what I think Andrew Gracie coined the term unintended benefit, no, the simplification in the corporate structure of banks as a result of all the resolvability framework. So I think in general, we are making progress, but of course, as mentioned before, we are in a half-baked banking union, which is inherently unstable. And if we don't go ahead, there are risks that, well, when the next crisis comes, we are in a more vulnerable situation. So we are in the middle of the road, quite frankly, and that's why it is so important to go ahead, in particular as regards EDIS, but other aspects of banking union that are still pending. So we should not relax. We should, I mean, what we have done should not lead to complacency, because there is a lot to be done. And if I may, I mean, in terms of vision, I mean, when we think about what is banking union about, I mean, we compare with the US, well, we are quite far from that. I mean, we made a lot of progress in the institutional side, but things in terms of what banks do in an integrated market in the US. And I take the case of one bank in the US, Wells Fargo. Who knows that Wells Fargo headquarters are in San Francisco? And who cares? I mean, who cares, and who establishes a link between the solvency situation of the bank and the solvency situation of the state of California? So we are quite far from that. And in the day we are in a situation in which any bank in the European Union, in the Eurozone, is operating anywhere with any client, regardless of where the headquarters are, or what is the situation of the sovereign, then we will be there, which is, I mean, we are quite far.
Yeah, thank you. Tom, representing a global bank that's based in a third country, you obviously are also, you know, quite active in the European Banking Union. I was going to ask you, how do you look at the home host issues and also the market fragmentation point? Do you find that EBU is helping with market fragmentation, or is it creating market fragmentation?
Thanks, Martin. Maybe before I get into fragmentation, I guess the first thing to say is just to echo the progress made on Pillar 1 and Pillar 2, so the SSM and the SRB. You mentioned we're a Swiss bank, so we've kind of been looking at the banking union from the outside in, but certainly we consider that a huge amount of progress has been made over the last 5 years. Less progress has been made, obviously, on EDIS. This has been kind of like noted. Yeah. But as the colleague was just saying, I think where we would love to see a bit more progress is on the kind of the fragmentation issue. And without wanting to kind of romanticize it, I think the colleague was talking about a vision. I think if banks have a vision within the banking union, it's to have a single jurisdiction that's kind of recognized as just one jurisdiction for capital and liquidity, and that you have a free flow of capital and liquidity between the different member states within the banking union. And unfortunately, that's not something that we're seeing right now. I think the good news, though, is that that ambition or that dream is shared by certainly, I think, the Commission and the ECB. If I remember well, back when the CRR2 was proposed in November of 2016, both the Commission at that point came up with some ideas around some waivers for capital and liquidity, cross-border for the first time between member states. There had to be some element of guarantee and collateralization within it, which I thought were very sensible. The ECB then came forward in their report and deferred even more to the hosts, I think, and said you can waive 25%, but you have to guarantee the full amount. And, I think it's very positive that at least at that stage there were some ideas around, generating and realizing this vision that hopefully we can pick up on. But that obviously didn't come through the political process. The other thing that didn't come through the political process, unfortunately, and it was mentioned on a panel earlier this morning, was this fragmentation of gone concern requirements. I'm thinking in particular of internal MREL for EU banks, but from our perspective, internal TLAC for third country banks. And that FSB range, which we think is really important, the 75 to 90%, that didn't come through. It didn't come through in the US, by the way, as well, but it didn't come through in Europe. So we have this fixed kind of, 90%. And if I may just on that point, just to kind of hover for 1 second, I think what we don't often say in that debate is that there we're talking about the gone concern kind of element really of loss absorbing capacity, and we ignore a huge amount of conservatism that has been built into the going concern requirement. So when we look at the crisis and we looked at the worst case for any bank during the crisis in terms of net equity drawdown, we think it was around 9% in today's money in terms of Common Equity Tier 1. So most banks now have way in excess of that in their going concern requirements, more than 9%, and then they have at least double that on top on their kind of gone concern. So there is a huge amount of conservatism already in the equity buffers that we've built, and therefore, with that in mind, it is a little disappointing to see that we can't get this, flexibility on the gone concern component. But look, we all know why. There's a very difficult discussion that's been talked about a lot this morning, home host. There is this idea, which I think is probably very well founded in some senses, that banks are European in life and national in death. We've still got these national insolvency regimes, but we've got a European resolution regime, and there's a potential arbitrage there. And I think host authorities are worried about kind of walkaway risk, and there were bad crisis experiences. So we know kind of why we've got to where we are. But I think this does matter. We have got growing ring fencing of capital liquidity, even in the banking union. I think it's a topic cross-jurisdictional, but you shouldn't really see too much of it within the banking union. Ideally, it's kind of this nationalistic banking sectors that we have within the banking union seem at odds with the kind of overall concept of a banking union. And one bank on a conference not dissimilar to this recently suggested there's up to 180 billion euros worth of trapped capital and liquidity right now. So I think there's a big prize if we can unlock that. Look, we think it's important to deal and focus on this issue of kind of fragmentation of capital and liquidity for a few reasons. I think obvious ones, again, mentioned earlier, this is suboptimal allocation of capital if you can't move it across kind of borders, and I think that weakens, growth. Banks' profitability, I think we did some back-of-the-envelope calculations. We think a drag of anything between 2 and 4% ROE, and European banks, I think, are struggling a bit with ROE kind of anyway. And then we've done some analysis, which the IF have deployed very well, and some of you are very familiar with, about how if you excessively pre-position, particularly gone concern resources, you increase the fragility of banking groups up to 5 times in some cases, because you make it harder for affiliates to support each other. So we think there are some very good prudential reasons to try and address this. And then finally, I would just say, getting this right, I think, should be one of the, removing one of the obstacles to more cross-border consolidation in the banking sector.
Thank you. Marie, can I ask you, there's been a number of issues raised here by the panel about, lack of cross-border banking, fragmentation, the doom loop, these things. How do you respond to those issues, and to what extent do you think at the next Commission cycle is going to be addressing some of these?
Well, I think we are very well aware, as Tom said, there is a big difference between our original proposal and the final text agreed. Traditionally, the Commission tries to really foster integration and cross-border activities. We acknowledge that it has been very difficult to negotiate that with the Council and the Parliament, and we link that to the legacy of the crisis and the difficulty that the member states have now in terms of trust and really overcoming this international in life and national in debt trauma. I think that the early stages of the crisis have shown that indeed, unfortunately, we had observed retrenching. And indeed, I think it was said also earlier in the panel, the state of the cross-border activity now compared to the figures before the crisis, we indeed observe some retrenchment. So we have to work on that. And that means that indeed, eventually, we will, I hope at some point, I don't know whether it will be this commission, the next one, the timeline is a bit unclear, and I can certainly not commit the Commission. They are talking about it now, so it's above my head. But I would certainly say that in the future, this Commission and the next one, these are items that we would want to tackle and remove all the obstacles. Right. We think that knowing the sentiment among member states, that will probably imply working on a mechanism that will reassure them, for example, in resolution in concern, ensuring enforceability, having mechanisms that, reassure them in terms of group resolution. If we manage to do something like that, then I think in this famous steady state we are now talking about, I think we will be able to then reopen the debate on the waivers, on internal MREL and so on.
Can I just pick up on that? Because I think one of the most interesting elements of the high-level expert group report was talking about, what are the things, the ingredients that need to be in place in order to reduce some of this fragmentation. And one of them was precisely that point about a legally enforceable parent support mechanism. And I think this is an area where the industry potentially can really contribute to the debate. Getting a fully fledged EDIS, harmonizing bank insolvency regimes, I'm not sure from a private sector perspective we can necessarily help too much. But with the IF and others, I think whether it's looking at secured support agreements, which I think are a very interesting precedent in the US, whether it's building on the mechanics in the original BRRD around intra-group support agreements, which I think haven't been used very much, or even thinking about funny incentives like, should we say to hosts, you can have 100% pre-positioning, but then you have no support from the group, or you can have 75%, and then you can have some form of kind of like top-up mechanism. I think this is an area where maybe we can move towards what, and I really liked it, what Chairman Enria said, mutually assured cooperation. So not mutually assured destruction, but maybe we can contribute to that debate around those mechanisms to ensure cooperation and reduce the host country ring fencing.
Tom, you mentioned insolvency laws. If we look at EBU in the larger European context, do you think it can support capital markets union?
Yes, I think so. I mean, the title of the panel is Future-Proofing Banking Union, and when we think about that, we think a good banking union must be one that can support capital markets union, and I would say that as a representative of a bank. But I think resilient banks have a really strong role to play in capital markets union as underwriters, as brokers, as market makers, etc. And I think there are some aspects of kind of prudential policies, some of that banking union single rulebook that maybe in the next cycle we can look at to support banks' role to be kind of effective market makers and to deepen liquidity. Maybe just to mention a couple, I see the clock ticking down, but two areas I think, particularly in equity market making, banks have a role to kind of like fetch securities from one part of the industry to another to satisfy, demand. If a bank goes to a big asset manager or pension fund to borrow securities to then give to an investor, the new Basel rules which are coming in are going to force the banks for the first time to apply a haircut to those lenders. The market works completely the other way around, and right now banks have to post a haircut when they're taking securities. And I think applying these new rules is not going to work in that new market context. I'm really pleased that the Commission called this out in their call for evidence, and I think the EBA are looking at it, but that's really important. And then the second area, and then I'll stop, is just, when we think about banks and equity market making, the liquidity and funding requirements for being an equities market maker and prime broker look to be very difficult when the NSFR comes in. We have to price long-term funding for short-term business, and this is when a lot of international investors come into European markets. Because of the heterogeneity of European markets, a lot of international investors want to trade on swap or through indexes, etc. When the banks take those hedges, those market risk hedges onto our balance sheet to be delta flat, we have to fund those things very, very long term, and that changes the whole economics of the business. So again, the EBA is looking into that, and I just wanted to give some concrete examples of areas where I think a strong banking union, if we look at some of these areas, can really help to contribute to deepening the capital markets, which is a big priority.
Thank you. We are almost out of time, but I did want to ask Doug and Santiago both to look at the future-proofing aspect. So we're in a world which is increasingly digital. BBVA is obviously an extremely digital bank. There are the cryptocurrency issues, Libra, those sorts of things. To what extent do you feel that the EBU is ready for this world, this digital banking world, and what steps do you think need to be taken? If you can both just briefly touch on that.
Good question. So I think we are facing a new environment for competition. We tend to have an approach to competition that is national and sectoral, and our competition is more and more cross-border and cross-sectoral. No? And this is where I think the Commission is already changing the approach, but I think they will probably need to work more on this because this is a new world. And data are the core of all this. So access to data and data sharing is probably the key aspect in all the competition environment between banks, between new entrants, and between, in particular, big tech. No? And there we have a framework in which, well, there is a certain asymmetry because as a result of PSD2, banks have to share data with third parties, including big tech, in terms that are standardized and real-time, whereas the requirements that are cross-sectoral, the requirements of the GDPR, the General Data Protection Regulation, are not, if you want, equally stringent in the sense that they are not standardized and they are not real-time. So that's why we are, in a way, advocating for an extension of the open banking approach to other sectors, so that really we have a data sharing framework that is working. Of course, this is difficult, this is ambitious, but I think this is the way to do it. And in this regard, coming back to banking union, and coming back to this vision of a really integrated single market of financial services, well, there is a lot of discussion about M&A, cross-border M&A being, if you want, the test case for the banking union, and it's fine to me. I mean, cross-border M&As are fine. But if we really have a digital single market for financial services, maybe there is less need for cross-border M&As. But what we need is a level playing field in this regard in terms of data sharing that allows banks to have an opportunity. I mean, the environment is very challenging for banks, but with this asymmetry, even banks that are doing their homework are with difficulties in competing, and this adds to all the other elements of the environment that are, as I said below, challenging.
Yeah. Thank you, Santiago.
Yeah.
Doug.
It's a big question, and we have very little time. So let me just hit a few key points. There's a long way from where banking union and the European approach is now to where it needs to be. Now, that's true for most places because you're talking about trends that are new and quite powerful. But in terms of non-banks are clearly playing a bigger role and will play a bigger role going forward. Part of that's digital, part of that's regulatory arbitrage as pressures on banks have gotten tougher. But it means Europe does have to find an approach to the non-banks that is sufficient for the purpose. Now, a piece of that is capital markets union. I am very pessimistic about capital markets union. Frankly, when you talk to people around town, it's just not up there on the list. And part of the reason it was there in the first place was it was a sop to the British to try to keep them in. You know, if you could just have a capital markets union that worked better, Britain being the principal capital market for Europe, would be more inclined to stay. That has gone away. There's a lot else that people are focusing on right now. And it's intrinsically very tough. I am confident some things will be done around the edges on Capital Markets Union, but the real issues are like bankruptcy law, taxation. These aren't things the countries in Europe want to tackle. If they do, it'll be part of some much larger movement that will be necessary before this opens up. And then I absolutely agree on the digital aspect. Data is going to be very important. This is something I could talk at much greater length on, but the point is we have this wave of change, of useful innovation coming from big data, machine learning, and other things. This wave is crashing into a wall of data privacy concerns. Now, Europe isn't going to throw away all that innovation by having an impermeable iron wall. It will be permeable, but how the rules are set up to allow a channeling of the innovation is going to be really important. Yeah. And the first attempt, and I give Europe a lot of credit for making the first attempt, but the first attempt with GDPR creates a number of problems that are going to have to be resolved.
Thank you very much. We are out of time, so thank you for a very rich and a lively discussion, and please join me in thanking my panel.